Hey guys, welcome to today's video. Many of you have heard terms like 401ks, IRAs, 457 plans, 403bs, and you want to know what those things mean. So I figured what we would do today is we would go over some of the basics of retirement accounts so that you can figure out what's the best plan for you and your family. Let's get started. Now, whether you have a traditional retirement account or a Roth account, and we will go through some of those differences, these are places where you can put money aside and hopefully it grows, and at full retirement age, which is 59 and a half, you can access that money. If you have a traditional retirement account, when you get to full retirement age, you can access it, but if you access money beforehand, you have to pay two different things. First, you have to pay a 10% penalty on the amount that you withdrew, and you also have to pay income taxes on that money in the year in which you made the withdrawal. Some retirement accounts are tax deferred, so let's talk about what that means. If you have a tax deferred account, that means that you have no tax obligation on that investment from year to year. With retirement accounts, you will pay income taxes on the money in your account at some point, either when you put that money in or when you take it out. But because it is tax deferred, during your income earning years, from year to year as that money grows, there is no tax consequence for having a tax deferred retirement account. Retirement accounts fall into one of two categories. They are either Roth, which is post-tax, or traditional, which is pre-tax. And you can have different versions of the same account. So you can have a Roth IRA, you can have a traditional IRA, you can have a Roth 401k, you can have a traditional 401k. The difference between the two is when you pay income taxes on the contributions or withdrawals. With pre-tax or traditional accounts like a 401k or an IRA, you do not pay income taxes on the amount that you contribute in the year in which you contribute. So you get paid, whatever you decide to put in that traditional account is excluded from your income taxes, and the more money you put in that account, the less taxable income you will have. Now, in exchange for this benefit, when you get to retirement and take money out of those accounts, the withdrawals that you make are treated as income in the year in which you take them. So you avoid taxes on the front end, but you pay them on the back end. Roth accounts work the exact opposite. With a Roth account, any money that you put aside when you contribute it, it is fully taxable. And in exchange, when you get to retirement, when you make withdrawals, that money is free from income tax. That is the difference between a traditional account and a Roth account. And in a future video, we're going to show you some of the things that you can use to help factor into the decision of why you would choose between those two items. I hope you found this video useful, and hopefully we share some information you can use today. Stay tuned for future videos on retirement planning, and if you have anything that you want us to cover in these videos, you can do so by going to my website, www.brinsonharrison.com, and under the blog section, there's a questionnaire you can fill out for topics you want to hear about. Please subscribe to us on Facebook, YouTube, and Twitter. We're going to keep these coming as long as they're useful to you, and I will see you guys next time.